Welcome to a video that I like to call the deep dive video. And for those of you that are new, I feel I need to explain this. I use the term deep dive in a bit of a different context. Every week I do a number of videos. I do a video each day. I do a weekly video. I do an intermarket analysis video. At the end of the week, I go through all of the daily charts and I put them together and make this video, including some additional charts that I include, because sometimes this can give us some additional insight into what's actually happening in the market. This is being prepared for Tuesday, December 26th. The first chart is a chart of the VIX, and this measures volatility in stocks. We also call this the fear gauge. Now, the VIX is on here, but it's invisible. On top of that is a 50-period exponential moving average. When the VIX is really going up, that means there's a lot of fear in the market. When the VIX is going down, that means there's not a lot of fear in the market. When we get to an extreme reading and start to turn either positive or negative, we use that often as a contrarian indicator. Well, the VIX usually uses static numbers, 12 to the downside and 20 to the upside, but the VIX doesn't always stay within that nice, neat little range. Other times we get from 20 all the way up to 40 and stick in that kind of a range. Other times we drop down to a lower range. After the COVID plunge, we went back up to a higher range. And now over on the right-hand side, we're potentially starting to make a lower range here as the market has been showing some improvement. We don't use this to make decisions. This is just more informational to let us know what is the overall reading of the VIX over a long period of time. Then we also like to measure how fast is the VIX moving. And to do that, I use an RSI based on 9 periods. When the VIX is really moving, we might get an extreme positive or negative reading. Right now, we're just about at the midpoint, so I haven't been including this chart. Then we look at the MOVE index, which measures the volatility of bonds on top. And then in the middle is the VIX, which measures the volatility of stocks. And then down below, I have the red line, which is the S&P. And then I take the MOVE and the VIX and subtract the MOVE index. And that's the spread between the two. What I pay attention to the most is on the bottom. And right now, their correlation is not really strong, meaning they're having a tendency to go in opposite directions of each other. Then we look at another ratio of the VIX to the MOVE index. And when this is really going down, that typically means stocks are going down as well. We did see a bit of a spike back up as we had the down day this past week, but now we've been coming and dropping down below the moving average. Then we take the VIX, and then there's another index called the VIX of the VIX, or the VVIX, and we do a ratio between the two. And longer term, when this is going down, that's positive for stocks. When this is going up, that's negative for stocks. We also look at the VIX and then take a 3-month average of the VIX. When this is going down, that's more positive for stocks. And then we look at a long-term version of the equity put call ratio. And when this is going down, that tends to also be positive for stocks. And then it's nice to know, where are we from the all-time high? That was set in January 2022. And when we look over on the right-hand side, that's where we closed. And we're down 1.33% from the all-time high. Now, this might be a little bit different than some other instances that you look at, because I did this on an intraday basis, but we're getting pretty close to that all-time high. We have 4 trading days left in the month of 2023. Do you think we'll be able to go and at least try to match with the all-time high, or possibly set a new all-time high in 2023? That's the question that we're wondering. Then stockcharts.com has a thing called technical alerts, and these are just automatically generated. They look at the S&P, they look at sectors, they look at other indexes. We even keep Canada on the list as well. And these are all of the technical alerts that were triggered for the past week. When they're blue or green, they're positive. When they're red, they're negative. And we read this from the bottom up. This was in Tuesday's session. We didn't have any signals triggered in Monday's session. And then the very last signal that was triggered is then red on the top of this chart. Then stockcharts.com also has a thing called technical analysis scores. 0 being the lowest, 100 being the highest. The higher the score, the better looking the chart. This tries to do things in an unemotional way. And for much of the year, the QQQs, which is the NASDAQ 100, they've been first, followed by the S&P 500, which has come in second. And there's 3 other indexes that we follow, with the Dow, the mid caps, and the small caps. Well, We're possibly going through a thing called the January effect, which tends to see small caps in more favor. And we're getting a score of 89.6 with this chart, where just a month or so ago, back in November, we were down into the teens. And this is really showing a big improvement for right now, and it's performing about the best. Then the Qs, which have been in first place for most of the year, now they're in second place, coming in at 87.2. Then the mid caps, which are in next to last place for a lot of the year, they're also showing some improvement, coming in at 78. Then we have the Dow coming in at 77.7. And in last place are is the S&P 500 ETF at 69.4. That's because the QQQs and the S&P 500, those are where the big mega cap stocks really reside. And they've held up the market a lot in 2023. They're kind of pulling back a little bit as we're seeing some more strength in the small and mid caps lately. Then we have some short-term charts. This is a short-term rainbow going from 10 periods up to 50 periods. And we're above all of the lines here and going up. So that's just showing us on a bigger picture basis here, when we take the whole chart together, that we're looking more positive. We also have some different moving average studies. This is a double and triple exponential moving average study based on 20 periods. And we're kind of right in line with this. This is more shorter term with both the blue line and the green line here. And I haven't been showing this chart because we've been well above other studies, really suggesting that we've been in an uptrend lately. And this is a regular 20 period simple and exponential moving average study. Simple means all 20 periods are the same. Exponential means there's more weight put towards more recent prices. And we're above both lines here and going up, suggesting that the trend is positive. And then this is one of our usual suspect charts. This tends to be pretty touchy. Earlier in the week, we were getting an extreme positive reading. We had the down day on Wednesday, and it automatically went down to extreme negative. Now we're more neutral right now. And then the CCI 14, after being extreme positive, is now starting to come down. We also have a CCI 20, which is still extreme positive. And then some intermediate term charts. Here's a rainbow chart going from 50 periods up to 100 periods, and the lines are really starting to turn back up, suggesting that the intermediate term trend continues to be positive. And this is the anchored moving average going back to the all-time high. That's the red line. We had come down here in October when the market was under pressure, but now we've been shooting up away from that, so I haven't been including this chart. And then we use the Connors RSI just like a regular RSI. We look for extreme positive or negative readings. We're above the midpoint now, so that's positive, but we're not getting any kind of an extreme reading. And here's the 50 period moving average study, the same concept here, where we have the blue line and the red line, and we're well above both of these moving averages, and that's suggesting that the intermediate term trend is positive. And then we look at a 100 period moving average study. This is also turning more positive because we're seeing the red line, which is the exponential moving average, cross above the green line, which is a simple moving average. The exponential moving average tends to go faster. And so that means that the upward thrust tends to be a little bit stronger. Then we want to know, are we above or below the 200-day simple moving average? We're above that, so we're green, and we're kind of far away from that right now. And then this is standard deviation, which measures how fast it's going, not direction, but when we were really going up, we saw the standard deviation starting to pick up. Then we had a down day, and as we've been flattening out as well, we did see standard deviation come down just a little bit, and we're coming right back down to the moving average. So we're not really seeing an extreme movement. When this really gets moving in one direction or the other, we see this chart really start to spike up. And then we look at the McClellan oscillator just for the S&P 500. When we're above zero and advancing, that's positive. We have been seeing some recent extreme positive readings now, but we're not at this time, so I haven't been including this chart. Then we look at a broader range of the NYSE McClellan oscillator. That's also above zero and advancing and not necessarily extreme. Then the percent B indicator, and we saw something pretty rare where for 4 trading days, we saw price go outside of the upper Bollinger Band, and that doesn't happen very often. That's when we get this extreme positive reading. We have been coming back down, but we're still above the midpoint, so we are positive. And then we use the CMB composite index. I use this like an oscillator. We spent most of the month of November being extreme positive, and then we fell back. And then as we were shooting up, we did get extreme positive, and now it's starting to drop back down. The mass index is not generating a signal right now. We only really pay attention to this when we get to the red dashed line and the blue line and we're far away. Pring bottom fisher, since we're going up, we don't use this signal. And then we're seeing an interesting phenomenon here. This is the S&P 500 on top, and then we have the S&P 100 on the bottom, and I have to clear my throat. Excuse me. Earlier in the year, we were seeing a divergence where the S&P 500 was starting to make a series of higher highs as the S&P 100 was making higher highs, where the S&P 500 was pretty much going more or less sideways. Now we're seeing kind of a reverse of that, where the S&P 500 is showing more strength than the S&P 100. Now you can take that as negative, saying that, oh no, the 100 stocks are underperforming. That's going to hurt the market. And that may be what happens. But you could also swing this over and look at it positive, meaning that, oh, that means the other 400 stocks in the S&P, they're starting to do better. And that's why the S&P 500 is showing some improvement as well. So you can take it either way. Then these are some measurements that we just try to keep an idea of where we're at on a percentage basis. We have the all-time high over on the left, which you can't see anymore, and then the low that we set back in October of 2022, and then the bounce up from there. And then when we topped out on July 31st of 2023, and then the market started to run into some trouble, and now we've been bouncing back up, and we're getting really close to coming back to that all-time high again. And then we look at a 50-day cycle, and I don't know if this is helpful or not. It's been helpful over the past year or so, but right now the market seems to be changing its characteristics, or as we're going from the Fed being in a tightening phase more into an accommodating phase for the market, this cycle may end up being useless. There are times when this cycle was helpful. It can mark a bottom. It's been able to mark a top. Other times it's been pretty much irrelevant. The next turn date that we're going to get is January 1st, but the market is closed that day, so it'll probably be on January 2nd. And then we take a point and figure chart, which just measures price, regardless of how long it takes. If it takes 5 minutes for this to move up enough to draw another X, or 5 months, that doesn't matter to a point and figure chart. And this is showing some improvement, and one more X on this chart, and we could get back to the all-time high. Then we're also looking at the S&P 500 and comparing that with bonds. When this is going up, that means that the market is favoring a soft landing, meaning that we have seen some economic weakness without going into a recession. Some long-term charts. Here's a long-term rainbow going from 50 periods up to 250 periods. We're above all of the lines here, and the lines are starting to turn back up. That's longer-term positive. We have the daily special K chart, which we're above the red line here. That's positive. And then this is a arithmetic scale chart, and people try to get fancy and say arithmetic. Well, it's arithmetic, okay? It's what we all took in school. There are different ways that you can plot technical analysis charts, and most of the time I use a log scale. Sometimes I'll switch over to an arithmetic scale or arithmetic scale just to see if that's giving us some insight. We did break above this line, and we're well above it, so I haven't been showing this chart. Then we have a weekly chart of the S&P on top, and then the German DAX weekly chart in the middle area, and they're having a pretty strong correlated relationship with each other. Germany has the biggest stock market in the EU, so if these two are going in the same direction, that tends to confirm each other. And then we look at the 10-year yield in the US and subtract the German 10-year yield. When US rates are higher, that means we get a positive result above the red line. And then we can plot the US dollar index down in the middle area. And sometimes there's a strong correlation between the two. When we're in this blue area, well, lately they haven't really been matching up. We've been seeing this going up as the dollar index has been going down. So this chart hasn't been as helpful as it has been in the past. Then we have different support and resistance areas. We're way above this downward sloping trend line, so I haven't been including this chart. We're coming back up all the way to the 100% level here with the quadrant lines. And all this chart is we take the COVID low up to the all-time high, break it up into 25% chunks, and just sometimes this will act as overhead resistance. Sometimes this is acted as support. And then we have a short-term fib chart that we were looking at for a lot of 2023. Well, we've been breaking out well above that, so this chart isn't really relevant anymore. Here's a longer-term fib study, which shows that we're in no man's land right now, and another longer-term fib chart showing that we're in no man's land. And we're also in no man's land when we do fib studies of the NASDAQ. And then we take a 20-period simple moving average of the open, high, low, close, and that creates this little mini rainbow, and we're above all of these lines here. That's more positive. And if we do start to fall back, sometimes one of these lines may act as support. And then we have the Ichimoku cloud, which we also use for support or resistance. We're above the cloud. If we start to fall, we'll see, is this green area going to provide some kind of support? And then here's another fib study for the NASDAQ 100. We are coming back and setting new all-time highs periodically over the past week. And so we're wondering, are we going to break out and get above this and set a new set of Fibonacci retracement levels? Or is this going to provide overhead resistance and we're going to come back down? The financial sector has been showing a lot of improvement, and it came down and tested this support level many times over the last couple of years, and now we've been bouncing back up off of that, and we're far away, so I haven't been including this chart. Some broad market measures. This is the Vixen, which is the VIX for the NASDAQ 100. I mainly look at the line chart down below, showing that even though fear picked up a little bit, it's still quite low. And then this looks at Treasury inflation protected securities. That's what folks get into in a rising interest rate environment because they can adjust and they have shorter maturities. When we stop raising rates and then rates start to come down, that's when folks want to lock in longer term bonds, because as rates are coming down, now they have a higher yield that's locked in for a longer period of time. And that's what we've been seeing, is this ratio has been coming down. There's just not a lot of inflation fears according to this chart. We're also seeing that same thing as we've been coming down since about the middle part of October with inflation worries when we compare TIPS with 7 to 10-year Treasury bonds. And then we look at a ratio between the QQQs and the diamonds, and it's showing that they're kind of going in the same direction at the same time. The bank ETF is showing a lot of improvement, in fact, enough to generate a golden cross recently. And then we look at regional banks and do a ratio with the financial sector, and we're starting to see a golden cross here as we're seeing more improvement in those areas. Some rated change charts. These are just for information, going back 250 periods, still looking pretty strong here. And this other 250 period chart is also showing things are still positive. Then we look at bonds. We have the red line here is the S&P 500. The blue line is the long-term bond ETF. Both in the long term, based on 50 periods, and in the shorter term, they have a pretty strong correlated relationship. And we look at the QQQs to the long-term bond ETF, and their relationship is also pretty strong, meaning that they're going in the same direction at the same time. Then we keep an eye on the yield curves, and the ones that the market really follows are the 10 to the 2-year and the 10 to the 3-month. They had been showing some improvement, but now they're starting to go back down. And so this is not normal, and this suggests that there may be a recession somewhere in the future. Once they go back to being normal, that's usually when we start the countdown to see, okay, is a recession going to actually happen? And that's the debate that's going back and forth. Then we look at shorter term bonds and compare them with longer term bonds. When this is coming down, that means that possibly the Fed is done raising rates. And my cat says, Merry Christmas to you. Then we look at longer term bonds and compare them with shorter term bonds. When this is going up, that means that the market isn't as concerned about interest rates. And then we look at cash and compare it with 3 to 7-year bonds. When this is going down, that tends to be more of an interest rate friendly environment. And then I have been showing a lot of possible positive scenario charts lately. These are the percent of stocks in the S&P 500 that are above their 200-day simple moving average. When we're above the midpoint, that's positive, and that's what we're showing right now. We can use this like an oscillator, but we're not getting an extreme positive or negative reading right now. So thank you. I hope you found this helpful. My cat says hello to everybody. I hope that you have a really good weekend, a Merry Christmas, and I will talk to you in the next video.